Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, December 1, 2020. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? We have, once again, new all-time highs. It's very important. We're going to go over a lot of different nuances on the chart. We're going to go over a variety of different charts. We're going to take a look at some new prices that we need to be aware of, and then we'll look forward a couple of days to see what's what can we expect going forward. Let's start with the first couple or three things that jump off the daily chart at me. The first thing we have to notice is the new all-time high, of course. So therefore, what we have is a market that's over the old high, which was 364.38. And what we're going to do is we're going to make 364.38 the new 358.75, at least for the time being. I'm not saying that price later on won't come to be important once again. However, for now, 364.38 is the same thing we had before. As long as price is above the former high, it's very, very bullish, and they can obviously move higher. Come back inside of 364.38 and close a day back below, and we have day one of a potential failure to break out on our hands. Again, this is premature, it's early, but that's the way you have to read it. You take it one step at a time, one candle at a time, one day at a time. Now, we have something else that stands out on the chart to me. It's small, but it's something. We have to be aware of it. We have a pseudo Doji candle. It's a little bit of a tail candle, but here's the thing. In the course, Lazy E-mini Trader, I go over these signs and signals of a trend change. So this is one of them. This is one of many. However, it's not coupled with something very important. In the course, we go over the items that need to be present in order to call for a market reversal. You don't really have them all here. What do I mean by that? You don't have tremendous volume to accompany a potential tail candle, albeit a small one, and a pseudo doji candle. So the market makes a new high, closes with a doji or pseudo doji, and generally speaking, a trader could take a short trade under normal market conditions if we had the volume to accompany that today, which we didn't. But a trader would be able to take a short position against today's high, saying, hey, if they close up above today's high, I have to cut and run. The trade was wrong. However, it's pretty close to risk. Therefore, it's a bona fide trade. That's the way you affect a good trade. That's the way you put on a good trade, knowing where it's wrong. Risk is close by. If you have to lose, it's small and fast. The thing missing here is capitulation volume or exhaustion volume in the case of a high. Here's what I mean by that. Remember this candle that we've been using from the 9th of November. Look at the volume on that day. You had 172 million shares. That's heavy volume. That would have qualified had we had something similar to that today. We didn't, but I want to point it out. It's a teachable moment. It's important information. Jot it down. Now, does that mean the market can't come down? No, that's not what it means. We use as many things as we can, what I like to call a full stack of information, a full stack of items. The more you have in the stack, the more the probabilities are in your favor, the trade is going to be right. That's all it means. We just didn't have the accompanying volume today. Either way, above the old high, the market is bullish. There's nothing bearish on the chart. It's above all the moving averages. The trend is our friend until it's over. Here's something that certainly could happen. Let's say the market comes down in the southern direction on Wednesday. Let's say it's below 364.38. Could they spend some time down below 364.38 intraday, yet close the day back above? And would there or would there not be anything wrong with the market? And the answer is nothing would be wrong with the market. Intraday, they can do a lot of stuff. And the reason I point this out, because you have a gap left open from Monday's close. So it wouldn't be out of the ordinary, it wouldn't be out of the realm of possibility for them to run down, make it look like the rally's over, make it look like things are failing, go fill the gap, turn around, and go back up in the other direction. They do that kind of stuff all the time, which is why I pointed out as an awareness. Now, here's what we do with that information. Let's say, and we're going to take it a step farther, let's say they are doing that. It's a hypothetical situation, but let's say they are doing it. How would we know whether the market is really failing or running down to run a test, fill the gap, turn around and run back up? We use the gap as a guideline. Are they closing candles below the gap? 15-minute candle, 30-minute candle, an hourly candle below the gap, 2 hourly candles below the gap. If they're doing that, it's the makings of a failure. If they hit the gap and bounce off of it, it's likely running a test until and unless they close back below the gap. That's the way we read the tape at the gap if they're going down by chance in a hypothetical situation on Wednesday. And by the way, I think I did that whole scenario without taking a breath. What about the flip side? What if they're pushing higher on Wednesday? What if they get above today's high? Where are they going? Well, the only real logical thing that we would have in our corner would be the next big fat round number. Not that they're going to get there right away, but there's no resistance in between today's high and the next big fat round number. What's that number? 3,700 in the ES, 370 in the SPY. It's not that far away. The closer they get, the more magnetic those numbers become. So it's just another awareness. If they're pushing above today's high, that's not necessarily an imminent target, but it's something to be aware of. They come up short by 5 or 10 points. They spike it through by 3 or 5 points. Either way, that becomes an awareness that we would have to have. Now, here's a 240-minute chart, and I want to point something out. Then we're going to take a look at another chart and point something similar out using a different chart. But go back a day or so and look what happened here. So this was actually on the 24th. The market gaps up, and it puts in a breakup candle. And just talking about the 240-minute chart, what did they do? They started to run sideways, eating time off the clock, building energy for the next move higher. They never did run a test of the lows up until what? Up until they did. They ran a test of the low of the breakup candle, turned around, never closed a candle. This is on the 240-minute chart. Never closed a candle below that low, and I'm talking about the low from the 24th, the low being 359.29. That number will sound familiar. We talked about it at the time. I don't know that I brought up or showed this specific chart. However, if I didn't, I should have. However, I am now. There's a couple of interesting things on this chart that traders who have taken the course Lazy E Mini Trader will specifically recognize. A, they did the thing in terms of a pattern that's taught in the course. So we teach it here all the time. It's not really a secret, but they did it. But the other thing they did, which is not taught here, which is taught in the course, is time was on your side. So when they ran a test of the low, think about what I just said, go back to the course, and you'll say, oh, there it is again. It comes in a variety of different forms, but when you know what you're looking for, it jumps off the page at you each and every time. So they made a bullish flaggish / bullish wedgish kind of thing, and then they popped the market higher this morning. Okay, fair enough. Let's check out a different chart that zeroes in on today's activity. How about today's hourly chart? Doesn't this span of time, this span of candles here in today's activity look very similar or the same as we just looked at on the 240-minute chart that resulted in today's move higher? And the answer is absolutely it does. Doesn't look identical, but it's close enough. So what did they do at the end of today? They ran down, at least in the vicinity of, in the neighborhood of, to run a test of the breakup candle low. They do this thing over and over and over again. They do it on all different kinds of charts, all different kinds of time frames. I say that every single day. It sounds like a broken record for a reason, because it's true. You're going to find that inside the numbers. You're going to find the expectation that the market was going to put in a mid to late morning high, Very similar, or the mirror image of Monday. We were looking for a mid to late morning low. We call it a morning low, and the market rallied for the rest of the day. Well, guess what? Today, we were looking for the exact mirror image, a morning high, and the market would pull back to do what? Run a test of the breakup candle low. Why did I expect that? Because they do it all the time. They do it way more often than they don't do it. Unfortunately, what they did was they didn't get high enough early in the day for me to short the market on the ride back down, and they kind of did the thing out of order. And what you'll see in the notes is much of the same. What I'm going to do in terms of the commentary today is I'm going to scroll up through the notes. I gave you the mainstay of information. Basically, the market just didn't let me have my way today. The numbers were the numbers, and you can see the numbers, double check the work, go back on the charts. I'm not saying the numbers are wrong. They weren't. All I'm saying is in terms of when the market was going to do what it was going to do, it just didn't happen on my time frame. It doesn't happen on your time frame. It doesn't necessarily happen on anybody's time frame other than the Trick, Trap, Fool, and Frustrate crew. But we have to know what to expect. Sometimes we expect things to happen. They happen anyway, but they don't let you trade the thing that happened. That's basically what happened to me today. I'm going to scroll up. I know that was confusing. Pause the video, read the notes, go back to the charts, and then I'm going to go back to the chart and I'm going to explain exactly what was in the notes using the pictures. Why is that? Because we think in pictures anyway. Then we'll do stocks on the move and a review, and I know people are waiting for the all beef patty shitburger explanation on Zoom today. We'll get there when we get there. Wasn't that big of a shitburger. I'm just using the term. Let me scroll up and finish the notes. I'm not going to read you the notes today. You should read the notes on your own. Pause the video and go back to the charts. You're going to see that if you're at all interested in the market during the trading day, active during the trading day, then you can use a tour guide to know what the market is likely doing. Where are the important numbers? What happens if they get above or below an important number? What's the next number? Those type of things, that information produces a trade. A picture's worth 1,000 words around lunchtime today, just pointing out the obvious, what they were doing and what they were also likely to do, which they really did do. I don't mean to sound cryptic. I'm going to go over the chart in a second. I just wanted to finish the notes, scroll up to the top. Before we get to the chart, let's take a look at stocks on the move, see what we had on our plate this morning. We had Momo and Zoom that hit their numbers. The other ones didn't, so we'll leave them out. Let's start with Momo, and here's what we've got. Getting a haircut at the open, they come into the first number that was the only number on the board, 1376. They blow through it like a hot knife through butter when you look at the 15-minute chart. However, when you go down to a tick chart, the minute chart, the 1 minute chart doesn't even show this. This one happened really, really quick. 1376, it bounces up to 1396, doing the minimum deal. You had to be quick if you were looking for that kind of a trade. Then it came down, and it did the deal anyway. It did it again later. Back on a real chart, the 15-minute chart, you can see it made a high of about $14 later on, and it never was stopped out by 10:30 a.m., so the trade worked. It did the base hit, and we know about base hits. They put you in the Hall of Fame. Was it a rocket ride? No. Was it a double, triple, or home run? No. That's okay. Base hits are fine. You never know what day and which trade is going to give you the double, triple, or rocket ride. We just plot along, we paint by numbers, and the market gives you what the market gives you. You know the thing about a box of chocolates, you never know exactly what you're going to get. All right, here's the all-beef patty. We've got Zoom getting a pretty significant haircut at the open. It gapped underneath the first number on the board. It's off the board. The second number, 427.55, as you can see, didn't work. The net, the stock got stopped out. The loss was about $10 after the hour of trading. So 10:30, the trade was over. And $10 on a $400 and some odd stock isn't the end of the world. It didn't work. The number was wrong today. We've had plenty of great trades on Zoom. This one, not so great. We move on. Just as a refresher, about 83% of the trades work. What does that mean? That means about 17% don't. This one falls into that camp. Awareness, life of a trader. What's going on over in Camp IWM? Well, interestingly enough, on a big up day like we had, the IWM actually underpaced the SPY on a percentage basis. Not by that much, so we can't really make a federal case out of it, but it's worth an honorable mention. Is there really anything wrong with the IWM? Absolutely not. Are they a little far from home base like the other markets? Sure. Can they come down a little bit? Can home base work up to price as they go sideways a little bit? Sure. Any of those scenarios is possible. What we need to keep in mind is the trend is your friend until it's over. There are some gaps down below. If we get below Monday's low, they'll start filling a gap or two. Until and unless they get below Monday's low, they're just high on the chart and they're going to be in a chop shop formation grinding higher. What about the folks down at the transportation department? What do we have here? Similar scenario, only this one we begin to put as a puzzle piece on the table. Why? Because the transports were only up about 1/3% today against the SPY. The transports are my second favorite market leading indicator. The IWM is a number one, so I have to take note in second place or the shotgun position, the transports didn't exactly have a tremendous day like other markets did. It doesn't mean everything's bearish. It's just something that I notice. Therefore, it becomes a puzzle piece. It's on the table. Doesn't mean it's going to materialize. They're still in an uptrend. And also, interestingly enough, the transports have already been working off some of that quote unquote, and I hate this term, overbought condition, letting home base work up to price coming down toward home base, going sideways to lower a little bit. It's really just eating time off the clock, resetting or recocking the gun. What about Q cubed? What did we say yesterday? We said 302.76 was a gap, and I wouldn't necessarily bet on getting rejected at the gap. Well, what happened today? They traded through the gap. They closed above the gap. But something else happened that we have to take notice of. What was the former high? Well, here it is, 303.50. So let's move from the gap up to 303.50. Now, when you do that, what you'll notice is that price came down to close below the all-time high, the former high, by 4 cents. Now, again, we don't want to make a federal case out of that, but I can't help but notice that. I live, eat, sleep, drink numbers when they do stuff like that, knowing that there are no accidents and no coincidences. I have to take notice. It becomes my own little secret puzzle piece, and it's on my table. The bigger thing is the uptrend, the highs that they're at, the all-time high, whether they closed 4 cents above it or 4 cents below it, doesn't really matter in the big scheme of things. They're at the highs. They're high on the chart. The moving averages are trending upward. There's nothing wrong with this chart from a technical perspective. But here's the thing. You have to take it one step further when you're an analyst, at least what I do. You have to be aware of all the things that can unravel the spool of thread. Doesn't mean they get unraveled each and every time. Doesn't mean it's getting unraveled tomorrow. But one time, when one of these little nuances happen, it turns into something more. And it morphs into something bigger, and it becomes a snowball rolling down the hill. We don't necessarily know when that's going to begin to take place, but we know that will take place. And therefore, we notice the nuances, we jot them down, we notate them, we're watching them, and if they become oh, by the way, that didn't really make a difference, that's fine. But we'll notice the next one, because there will be one of them that does make a difference, and guess what? It'll help us hop on a sleigh ride down south before most everybody else realizes it's taking place. We don't anticipate it, we don't guess at it, we watch and we let the market tell us what it's doing and what it's likely to do next. Is there anything wrong with the XLF as long as they're above 2680 on weekly closes? And the answer is absolutely not. Look what they did today. They ran another test of the former gap. The gap's been filled, So it doesn't really matter anymore. But what happened? They created another gap. So what did they do? They filled the newly created gap, and then they filled the old gap anyway just because they were up there. 28.55, that's what they did today. Doesn't really mean much. As long as they're above 26.80, it's bullish. That's on weekly closes. Move on. Smash Mouth. Is there anything wrong with the market as long as the semiconductors continue to grind higher, continue to power forward in an uptrend? And the answer is absolutely not. As long as the semis are fine, which are a good proxy for the tech sector, which is fine, which is across all market sectors, it's a bull market in an uptrend until it's not. By the way, just for argument's sake, where's the nearest breakout area for the SMH where they're likely to come back down to run a test of sooner than later? About 202, 203. The market or the SMH ran up to that price, was rejected, ran up there again, 8 time off the clock, then broke out. So in that general area, 203, 202, somewhere in there is the most recent breakout area. So jot this down. Next time the SMH begins to sell off and you get a couple of 3 days worth of a sell-off and they pay a visit or run a test of 202 or 203, guess what? You're likely to find at minimum of some intraday support. How about gold? I meant to talk about this yesterday being the close of the month. I forgot, but it's still valid. It doesn't make any difference. We can talk about it today. We had two numbers. My first number was about 170. My next number was about 165. Precisely, it was 165.34. What you'll notice here is yesterday's low was 166.03, very, very close to that 165.34. Let me point out what represents 165.34 and a little bit of an explanation why. We already talked about this, and I want to point at it once again. So here we have a big breakup candle, and the low is what? 165.34. What did they do? After putting in a top, they came down to do what? You got it. They ran a test of the most recent breakup candle low. Where have you heard that before? And guess what? This is a monthly chart. What was yesterday? The close of the month. They were down there at the end of the month. Interesting to say the least. They closed the month above the breakup candle low. Now, what about the month of December? Can they dip below it? As long as they close back above it, the answer is, of course they can. As long as they close back above it in December and January and so on, then this particular breakup candle is something to watch. However, if they close below it by the end of a month, then we have to go down to the next breakout area, which is what? All the way down here at 140. Do I think that's going to happen? No. Are there other support areas in between on weekly charts, daily charts? Absolutely there are. I don't think it's going down to 140 anytime soon. Market doesn't care what I think, but I'm telling you what I think either way. What do I really think? What I think is it's in a long-term uptrend. This is a pullback in that uptrend. And guess what? Even if they come down lower yet again, I'm going to continue to be a buyer of gold. Was I a buyer of gold last week? Yes. This is the spot I discussed earlier. This is the spot I began to buy gold at 170 and below. If I told you how much I appreciate you, without you, these videos are not possible. That is true and accurate information. We're going to pull the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.